So we'll get going right now. Again, my name is Jeff Yonamin. I am with Exchange Resources. I'm filling in for Debbie and Frank. They have conflicts and Debbie is sick, so we'll go ahead and step in and do it for them. I am the Northern California manager for Exchange Resources. I've been doing this from the get-go, so this is our 25th anniversary. So I want to say thank you very much for supporting us in all your 1031 exchange endeavors to keep us going for 25 more years. We appreciate that. So Exchange Resources is a national 1031 exchange company. We're based out of San Diego. We have done over 60,000 1031 exchanges, and we held over 30 billion in exchange funds. We carry Fidelity Bond, Arizona Mission, and a separate trust account for each investor that does their 1031 exchange. And we are a debt-free company, so we have no lending on our side. So that's a number one, a plus for us to have our financial strength. So we always look at the client's funds as one of the high priorities within our company. So it's safety of funds for your investors, and that's why we carry all the insurance and E&O. So that's what we do. We are the holding company, so your clients could do the 1031 exchange. And 1031 exchange is the tax section, 1031 of the IRS code. So the disclaimer here is this presentation is for educational purposes only. So we always request that they talk to their CPAs or legal advisors. And basically you want to recommend that they do that too. Okay, we do not give tax advice and we do not give legal advice because we are the holding company, so the clients can do a 1031 exchange. So for investment properties, what happens if you just sell an investment property? You just have to pay the tax. And if it's highly appreciated, then you got to pay a lot of taxes. And so that's why when you look at the amount of taxes that you got to pay on a piece of property, it's going to be in the neighborhood of about 1/3 to 40% of your tax bill will have to be paid in taxes. And that's why a lot of investors do 1031 exchanges, because the tax bill is quite stiff. So if you sell a property for 1.5 million and you got $1 million gain because your cost basis is 500,000, then you're going to be paying a substantial amount of taxes to the IRS. So there's two types of taxes. There's short-term capital gains, which is the property was held for less than a year. And there's long-term capital gains, which is basically properties held for more than a year. So the long-term capital gains, you get the tax brackets. The short-term capital gains is just based on your ordinary income. So be aware of the California withholding, the 3.33%. This is an estimated prepayment amount for the state of California, Franchise Tax Board. So they're going to do that 3 1/3 based upon the sales price, or you got to get your CPA to do the full capital gains, and then it's going to be 12.3 of that amount. And that's if you don't do the 1031 exchange or if there's a failed 1031 exchange. So you have either or on that. So unless the seller does elect to do the 1031 exchange, right, on the 593 form, it's going to have a box there, box 10, that you fill out and check. So you don't have to have the withholding done. All the net proceeds are going to come to us to do the 1031 exchange. If you have a loss on a property, you're an exempt corporations, LLC, banks, and insurance companies. So any cash that is not used to roll over and reinvest in the new property is subject to the 3 1/3 withholding. And also seller carryback financings on the relinquished property. So this happens whether or not they do the exchange or if the exchange fails. So just make sure that you have your client talking to the CPA and escrow regarding the 3 1/3 withholding. California has instituted what they call the clawback. Because 1031 exchange is a federal law, you could go do a 1031 exchange in all 50 states. However, if you sell a California property, you must be aware of the clawback. If you go to another state, California is going to track the gain that left California to the other state. And you must file the new form, the 3840 form, the year in which you do the exchange, and every year thereafter until you either sell the property and pay the state of California the taxes back, or if you pass away or die. So it's forevermore, if you go out of state, that you have to file the 3840. So before selling the property or listing the property, when you meet with your clients, you need to ask certain questions. So what is the property use? So if they're selling a primary residence, they cannot do a 1031 exchange. If they're selling a second home that they never rented out and they're not complying to the guidelines of the second home 1031 exchange, they cannot do a 1031 exchange. And the rental properties that we're hearing now, some of them are not even shown on their tax returns, or they're well below the fair market rent, or there's family members renting the property at a very discounted price. So you have to make sure that you're talking to your clients and finding out what the use of the property is. Very important that you need to do that. And then you have to ask, when was the property acquired, right? When did they buy the property? What kind of capital gains tax are they looking at? That's why they have to talk to their CPA or tax professional to know the potential tax liability. And then how is the property owned? We're always looking for continuity of ownership from the sale property to the purchase property. Is it an individual? Is it a living trust? Is it their LLC? And if it's a multi-member LLC, then that's considered a partnership. And so then the LLC would have to do the 1031 exchange, and they won't be able to go their separate ways if they sell in a partnership. And most importantly, always, always, always talk to your tax advisor or attorney, financial planner, or even talk to us, the qualified intermediary for the IRS, such as Exchange Resources or any other 1031 exchange company. So the solution is going to be the 1031 tax deferred exchange. So it's not tax-free and it's not a loophole. It is actually the code section 1031. So they could look it up on the IRS website, irs.gov. You look under section 1031 exchange, and then it's there. So what is a 1031 tax deferred exchange? A 1031 exchange permits the sale of a property that an investor owns for the productive use in a trade or business or for investment purposes for another like-kind property held for productive use in a trade or business or for investment purposes. So remember, it's the intent to hold the property as investment is paramount. That's what the IRS is looking for. There is a recommendation of the holding periods. It's 2 years or two filing of 2 tax years on the Schedule E. But those are just the guidelines, okay? The IRS is really on the intent to hold as investment. So You always have to, if it's less than 2 years, we always recommend that they talk to their CPA and make sure that they understand that it's less than 2 years, that the CPA is okay with them doing the 1031 exchange. Because the IRS is going to be looking for that property on their Schedule E. And so that's why investors do the 1031 exchange, to defer the payment of the capital gains taxes. And they get to reinvest 100% of all their net proceeds to the new property. Any cash that they don't use is just taxed as capital gains, right? So it's not to avoid tax, and these are not tax-free exchanges, as some people have said. They are tax deferred. So basically, you're just moving it down the road to pay the taxes later, or what we say in the industry, you just exchange, and then die, and then give it to your heirs, right? The heirs will basically be a stepped up in basis. And we'll get into that a little bit down the road. But based on our example of the $1.5 million piece of property, so if you sell the property and you don't do an exchange, you got about a 40% tax bill. So you're going to be paying about $400,000 on $1 million gain. But if you do the 1031 tax deferred exchange, you get to reinvest the whole amount, right? All your net proceeds roll over, and it's basically you're deferring all your taxes. So you're using tax money to buy more property. And that's the benefit of the 1031 exchange. Not paying the taxes, but using it to reinvest and buy more property. That's why one of the goals for 1031 exchanges is the wealth factor, right? This is how corporations, the rich get richer. They use 1031 exchanges to build wealth. And that's why you do 1031 exchanges. You also get, as an investor, depreciation. So you get to do a paper loss on a property that you rent out. So only on the improvements of the property, not the land, and is due over time. So when you have a residential rental, apartments, 1 to 4 units, it's based upon 27.5 years straight line depreciation. You get a certain amount of depreciation paper loss per year up to 27.5 years. Commercial is 39 years. And there's also some other stuff for personal property and improvements for the landscaping and shrubbery, which is a lot shorter. It's a 15-year depreciation schedule. So it's a dollar reduction on your tax returns on your Schedule E. So this is one of the benefits of doing 1031 exchanges, is the depreciation deductions. But as we talked about the previous slide, was what are the benefits of 1031 exchange? So when you talk to your clients, the benefit, number one benefit, is always the accumulation of wealth, because you're using tax money that you would have had to pay Uncle Sam to go reinvest and buy other pieces of property to accumulate wealth. And that's how the wealthy get wealthier. You can improve cash flow, return on equity, by buying multiple doors from a single family to a fourplex, and that's going to improve your cash flow. You get new depreciation. You can diversify, and you can consolidate. So you could sell one property and buy 3 properties. And you could sell 3 properties and also consolidate it and buy one big property. So the benefits of the 1031 exchange are very vast. You could change investment property types. So you don't, if you have rentals, you could stay in the rental market, or if you want to go to commercial, you could step up and do office space, warehouses, industrial, retail. You have all these different options under the 1031 exchange to diversify your portfolio. If you're moving from one state to another, you could sell your investment properties, let's say in California, and if you're going to move to Texas, take them with you by doing 1031 exchange. Do an investment 1031 exchange and buy another investment in Texas. And people do that a lot. You could use 1031 exchange as an investment or estate planning tool also. So this helps a lot of retirees set up their retirement. And if they want to give a certain property to their kids, they can start doing that through the estate planning tool by doing a 1031 exchange and then allocating it under the trust. And this is where your trust attorney needs to kind of step in and plan that with your clients. So one of the things that for the estate planning is we always say exchange, 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 and die. It's just because we say swap till you drop. And that means you invest, you keep on doing 1031 exchanges all the way through your life until you pass away, because upon your passing, if you set up your trust correctly, then your properties will transfer at the time of death to your heirs at a stepped up basis. Stepped up basis means whatever the fair market value at the time that I die is going to be the inheritance basis for your heirs. And that's where they get it at that value. And so if they turn around and sell it the next day, they shouldn't have any capital gains. They should actually have a loss because of the cost of selling the property. So that's why if your clients are going to invest in real estate, they should have an estate planning attorney that's going to set up their trust properly to avoid the probate, because probate becomes a big issue. So if you don't have a trust that's going to do that, you have to go to probate. And it's taken about 2 years for investors' properties to go through the court system because there is no trust set up or will, and it has to go to probate. So always talk to your CPAs, estate planning attorneys to get the correct advice to set up the trust. A good example of that was, a lot of high-profile people like Michael Jackson and I think also Prince. They didn't have trust for their estate. And so a lot of their attorneys just never set it up, because if it goes through probate, they get a fixed amount of attorney fees to basically mitigate that whole estate. So that's pretty huge. And so when I saw that, I said, a trust is very economical now. You could set up a trust for $3,000 to $5,000 that will help pass your properties on to your heirs. And that's the beauty about the trust. So keep in mind, when you have investors, you should always kind of recommend that they set up a trust in regards to their holdings. And they can move the properties in and out of the trust too. So it's not stuck, just because you have a trust. So you as realtors for Orange County, there are a lot of investment properties in your market. Okay. There's just about 150,000 absentee owners. And these are for probably, I think, non-owner occupants for single family residents. And of those, there's just like 17,000 that live out of state. They do not even know what's happening to their properties here unless they have a family member that's watching it for them, right? And so that's why you could tap into this market by talking to your title reps. Your 2 to 4 market right now up here in Northern California is going crazy because they're moving their properties around. So if you guys got 14,000 2 to 4 unit property owners, that's a really good market to tap into. So if you're looking for another sale or some type of listing, this market right now is still alive. So if you're having problems with the owner occupants, look for the absentee non-owners, okay? And then as Frank and Debbie would say is, wouldn't you like a piece of that market? And you don't need a lot of it, right? You just need a few investors to go ahead and help you start selling these types of properties for you. So you can increase, right, your business dramatically just by having a handful of 1031 exchange investors. So that's why talk to your title reps. There are certain requirements that you can ask them to say, hey, I'm looking for non-owner occupants. You know, they have a lot of equity that they're looking to reinvest. Are they looking to get larger or better properties? And that's one of the things that a lot of investors are doing. They're taking the old investments and they're moving them up to a better investment or a larger investment that has less deferred maintenance. And if you go high enough, right, you'll get more tax write-off because you get more depreciation schedule write-offs. So that's why you need to talk to your CPA to find out if that's going to be a feasible thing to do, the 1031 exchange. So that's why diversification, consolidation are really a big factor right now with the investors because they're looking to move up or move down. So an example of a diversification or downsizing, we have one client selling their office building, which they actually occupied, and they're downsizing it to a smaller one. And plus they're going to diversify and buy some rental units. So you could split it up under the 1031 exchange. So you could buy a new office building that they're going to occupy for the commercial side, and then they can have residential rentals. So you have a mixture of both. And the outside owners. The outside owners, the biggest thing is they could take their investments back to the states of where they're at, right? So if they're in Tennessee, Texas, Oklahoma, they could sell the California property and move it back to where they live, and it becomes easier to manage. So we have seen a lot of that happen over the pandemic. There has been a lot of people taking their properties to the states of where they're living now. And so that's a good market to get into also. So these are some good ideas that you should keep in mind. So when you talk to your title reps, you can ask them these questions. These are the types of properties that I'm looking for. And also Exchange Resources can help you out. So Debbie and Frank can help you with samples of target letters to the non-owner occupants. There's marketing materials. We have exchange brochures that you can send to them. They could do one-on-one calls with you and your clients to kind of show them what's the benefit of the 1031 exchange. Because some of the investors that I have talked to in other states don't know about the 1031 exchange where they could sell the California one property and exchange it back to the state and where they're at. So that could actually help you get a listing. And if you have the buyer, it could also help you put that buyer into a property. They'll actually, Frank and Debbie will teach classes to your investors so they can put on an investment seminar. So if you have that, something that you want to do, you could do that on Zoom or you could do that in person. So an either or type of situation. And they'll talk about the benefits of the 1031 exchange and how to use it. So they could go ahead and sell the property, defer the capital gains tax by buying other investment properties. So they're also on call to support you in any way that through the 1031 exchange. So feel free to give them a call, ask them questions, or meet with them, and they can help you out regarding the tools that we have for the 1031 exchange. So what doesn't qualify for a 1031 exchange treatment? Number one is the primary residence, because that is a different tax code. Primary residence is under Section 121, where you get tax-free money for living there 2 out of the past 5 years. As a married couple filing joint, you get $500,000. As a single person, you get $250,000 over and above your cost basis, right? So it's of the gain. So that's going to be part of the gain. Anything over those limits, then you just pay long-term capital gains tax because you live there over the 1 year period, because you have to live there at least minimum 2 years. So what we're seeing right now is some of the agents are saying that you could do a 1030 exchange on a primary residence, and that's not true, because they'll say they only live there 18 months and then they want to sell it, but they have gain in it. If they sell it and they didn't meet their 2 years, they will have to pay the capital gains tax on that primary residence. So remember, they must own the property and occupy it for a minimum of 2 years before they could qualify for that primary residence exception. Second homes that are not rented out and classified as an investment property do not qualify. Majority of the second homes are never rented out, and they're always used by family members, and therefore that pay no rent, and therefore they do not qualify being held as investment. And that's why the IRS says no. Flippers and dealer properties. This is where your intent to hold is not to hold as investment, but is to what? Create a quick buck. And that's why IRS says no, these are dealer properties, do not qualify for 1031 exchange treatment, even though it's real estate. Stocks, bonds, mutual funds, and REITs do not qualify either if they even invest into real estate. That's like the REITs, right? You get a stock when you buy into the REIT. So therefore, that's personal property and not real property. Partnership interests do not qualify because that, again, is a personal property interest. You're not buying real estate, even though the partnership invest in real estate. The individuals own a part of the partnership and not of the properties. Mortgages, notes, deed of trust, seller carrybacks are personal property. And that's why they don't qualify. So you can't do a 1030 exchange and pay off your primary residence mortgage or another mortgage on another property, because those are considered personal. So these are the things that do not qualify for 1031 exchange. Also, businesses do not qualify. So if you buy a restaurant and the building, you can only 1031 exchange into the building. You cannot 1031 exchange into the whole thing. You got to take out the business opportunity of that. Or if you're buying gas stations, the gas station has some type of value in the business. So you got to take that out of the sale, right? And only do the real estate. And vice versa. When you buy, you can only buy the real estate and not both the real estate and the business. So we talked a little bit about Section 121, the universal exclusion, right? As a primary residence, living there 2 out of the past 5 years, and they do not have to be concurrent or consecutive. That means you don't have to be at the same time. So you could live there, you could rent, right, for 2 years, and then you could own it for 3 years, and it could be in different sequences, right? So that's why it's all, they look back from the close of escrow of the property. Did you live there 2 years? And if it's yes, that's one part. And did you own it at least 2 out of the past 5 years? And that's the second part. So you got to make sure that you qualify for both ownership and occupancy use. So any amount over the limits of the $250,000 or $500,000, it's just taxed as long-term capital gains tax. Second home, vacation homes do qualify if you follow the safe harbor rules by the IRS. It's Revenue Procedure 2008-16. So in 2008, they came out with guidelines, and these are the guidelines. 24 months before and after the 1031 exchange, the owner has to own the property at least 24 months. Property was rented at fair market value for at least 14 days per 12-month cycle for the first 2 12-month cycles, or the 2 years. Okay, so if they're selling a second home, they're going to look back from the date of sale, 24 months, and then they're going to ask, did you rent it out minimum of 14 days, right? And the second rule is going to be they allow you personal use of 14 days, like a 2-week vacation, or 10% of whatever it was rented out per that 12-month cycle, whichever is greater. So it's going to be treated both as some personal use and some rental. But the IRS says the rental is a must, right? You have to rent it out at least minimum 14 days per 12-month cycle for the first two 12-month cycles. So you could do Airbnb, VRBOs. They do qualify now. However, you've got to look at the state in which you're buying it. So, like San Francisco, right? They said now you have to what? Live in the property if you're going to do Airbnb. New York is going after Airbnb. State of Colorado, right? They're saying we're going to triple your property taxes if it's an Airbnb. So these are all those things that are popping up with the Airbnb that you have to make sure that you're aware of, for your clients. So you just got to make sure, hey, go find out what the state is doing regarding the second home vacation homes, because you may not be able to do your Airbnb there. But you could do second homes, but you got to make sure that you still rent it out that minimum of 14 days. And that's critical. So this 14 days, the IRS is looking for, because you have to show that on your Schedule E, the rent. Okay. And that's how you classify it as an investment property. And then after you qualify for, this is the safe harbor guidelines by the IRS. After that, you could do whatever you want. You could not rent it out anymore. You could use it just strictly as a second home. Or if you decide to go over there and stay there for 6 months and then come back to wherever you're at for the other 6 months, you could do that. So it's kind of like wide open. So once you complete the 24-month period, the use of the property becomes very broad. But during that 24 months, it's very restrictive, and you got to follow the guidelines by the IRS. So that's why always talk to your CPA or tax professional regarding that. What about mobile homes? Typically, they don't qualify because they're not affixed to a permanent foundation, right? They're not hooked up to the slab that's underneath. Typically, they're on stilts, right? And typically, you could put wheels underneath here to basically roll away the mobile home. And that's why a lot of them do not qualify for 1031 exchange treatment. And then leased land, remember, if it's leased land, this pad that you're leasing here would have to be what? A minimum of 30 years or more left on the lease to qualify for that affixation to the ground of the leased land. So some states do have leasehold, like Hawaii has fee simple and leasehold. So we always check when people are buying or selling in Hawaii that the leasehold is 30 years or more, including options to be considered real property, because some of the leaseholds are less than 30 years. So there's something to know about the mobile homes, because we always ask that question when somebody brings that up. Oh, I'm buying a mobile home. And then we ask them, is it permanently affixed to the foundation? If not, then typically that's not going to qualify. So what are the other types of 1031 exchanges? We have the delayed and simultaneous. This is where you sell first and then you buy second. You have the reverse exchange, which is the opposite. You buy first and then you sell what you need to sell. So this gets rid of the stress of finding the replacement property, but they're more expensive. Okay, they're going to be about 10 times the amount of a straightforward exchange. The build-to-suit exchange is where you buy and you identify your improvements of what you're going to be doing to the replacement property to improve that piece of property. So you could do that, and that gets very expensive, and you should have all your contractors and vendors lined up to do that improvement on the property, because you have the 180 days that you have to complete your exchange, but you don't have to complete the project. You have to complete the exchange, and that's what the value to value situation. And you could do the simultaneous. We could close the next day or the same day. We just have to make sure that we know that that's something that you want to do for the 1031 exchange. And then the hybrid exchange, this is where you can combine any type of two of these 1031 exchanges, and then you'll have, you know, a straightforward with a reverse. So let's say you're selling 2 properties and you want to consolidate it into one, but you have a problem selling both properties close together. So what happens is the seller of the property you want to buy says, hey, the first one closed, and our contract says, hey, you got to close in 90 days. And it's coming up to the 90 days, they're probably going to do a force, if there's no contingency, a specific performance to make sure that you close on the deal. But then your client saying, I want both properties to go into this one property. So you would have to do a hybrid exchange where you do a straightforward and then you backdoor the second property as a reverse exchange. So you'll be doing 2 types of exchanges, a delayed straightforward with a reverse exchange. So those get complex, but those can be done. So we always recommend that you talk to Debbie and Frank to set those up, because you'll be dealing with probably our attorney, Shirlene, and her team that's going to be handling those types of 1031 exchanges. So the first one, the delayed exchange, right? This is the most common 1031 exchange. Everybody calls it the Starker exchange, but that's basically because Starker was the most famous person that challenged the IRS. And that is how we came up with the 180-day exchange period. And the first 45 days of the exchange is the identification period. So this is where we get the 45 days and the 180 days. So the IRS says, hey, we don't want you out there just taking 3 years to go ahead and do your 1031 exchange. Since we're going to defer the capital gains, you have to be very specific and you have to do it fairly quickly. And so they said 180 days to do it, but tell us in 45 days what you're going to buy. Simultaneous exchange, it happens on basically the same day or the next day. So we just have to know that your client's going to be doing that, and we can set it up to close concurrently or the next day. This also qualifies for the safe harbor that you need to use a 1031 exchange company, because if it's the next day, the money is just going to be floating for 1 day, but it goes from property sale to property purchase. The reverse exchange is where you're buying first. So it all depends upon how you're buying the property. We have to set up what they call an EAT, an exchange accommodation title holder, for the property that we're going to be holding, either the property you're selling or the property you're buying. And so that all depends upon how you're buying the replacement property. If you buy all cash, we step into your shoes at the close of escrow of the property you're purchasing, and that starts the clock of the 180 days and the 45 days to identify the properties you're going to sell. If you're acquiring the property with a loan, the lender will not let us take title to the property that you're buying, because that's one of the requirements. It has to go to the taxpayer. So therefore, 2 weeks before they actually close, we have to start taking title to the property that they're going to sell. And once we hold title to that property, that starts the 180-day clock and the 45 days to identify. So that's why on a reverse exchange, it helps you not have the stress, right? Because you found the property of finding the replacement property. And it's this type of reverse exchange is used in low inventory markets, kind of like what we have now, right? So we're seeing an uptick in reverse exchanges. And so you want to make sure that you're aware of the reverse exchange to your clients, that you can use it, but they are going to be expensive. So you have to tell them, it's almost like 10 times the amount. And we'll get into the prices later, and you'll see that a reverse exchange is going to be about $8,000 to $9,000, and the straightforward is going to be $1,250. So be aware of that when you tell them about the reverse exchange, but it's an option that's out there for them. You could do build to suit. So now we're getting into more sophisticated 1031 exchange, where you can actually sell your property, buy like a fixer that has work to be done on it, and you identify the property plus the improvements that you are going to do to the property during the 45-day identification period. We still have to hold title at the close of escrow to the property. And then we use the excess exchange funds to what? Do the improvements on the property. The caveat here is if you're getting a loan on the replacement property, it's going to be very hard to do the build to suit with a conventional lender. You probably have to go hard money because what's going to happen is they're not going to let us hold title to that property during the construction. So I recommend that you either find a hard money lender or buy it all cash and then use the excess cash, right, to go ahead and make the replacement on that property. So this one, I would highly recommend talking to our attorney or to Frank and Debbie to see if this is going to be something that they want to do. Oh, so what is a 1033 exchange, right? There is a difference. So some people get an offer from an agent, but they're representing a government entity that's probably buying that property for the good of the community or for the whole. And so it could either be a condemned property or a threat of eminent domain or anything like that. Those are going to be 1033 exchanges. So we don't do the 1033 because the 1033 are involuntary sales and 1031 exchanges are voluntary. So that's why you have different guidelines. Because 1033, there's no ID period, right? You just got to make sure that you buy the property within the certain amount of time that the entity gives you. 2 to 3 years is typically the rule. You don't need a QI. The money goes directly to the taxpayer, and there are different guidelines for what is like kind. So that's why we always recommend that they get in touch with their CPA because these are involuntary conversions for the homeowner. Oh, there we go. So I'm just waiting for the computer. Sorry, guys. Okay. 4 basic rules for the 1031 exchange. Needs to be like-kind property. To the IRS, like-kind is very broad. If they're looking for the use of the property as investment, it's not the property type. So that's why all types of real estate qualify as long as it's held for investment purposes. You want to buy equal to or more in value than the property that was sold. And the reason being is all the net proceeds from the sale must roll over into the new property as the purchase or as the down payment. Any cash that they take is going to be taxed as capital gains. Any debt that's on the property, you must acquire an equal to or greater amount of new debt on the property that you sell. So that's how you get pretty close to equal to or more when you do a 1031 exchange. So it's always value what you sell to value of what you buy. Timelines of the exchange. It starts from the close of escrow. So a lot of agents think that once I list it, that starts the exchange. That doesn't. It's just the listing period, right? Once you get an offer, they think that starts, and they tell the client, you got to identify within the escrow period. That's not true. It starts at the close of escrow. So if you don't close, you have no exchange. So that's why IRS says once you close, 180-day calendar starts. You have 180 days. These are calendar days, not business days. First 45 days is when they have to identify the target property. And the fourth thing, we have to know who the seller is that's selling the property. So we talked about continuity of ownership. The IRS is looking for who the taxpayer is. Is it an individual, a trust, an LLC, a partnership, a corporation? Whoever that is must be the buyer of the replacement property. Same thing, individual, LLC, trust, corporation, partnership. These are all the things. So that's why it always goes from who is selling to who is buying to make sure. Like kind, rental property to a fourplex. You could do commercial land. You could do easements are also considered real property. You could do it into Delaware Statutory Trust, the DSTs. They look like REITs, like down here below. They look like these, but they're not REITs. Okay, these are private placement, closed-end funds, and that's why they qualify per the IRS as ownership, because you get an ownership in the trust that owns the DST, the property. Leasehold interest, 30 years or more, considered real. And you could do it anywhere in all 50 states. And if you have property that's outside the United States, then you have to do a 1031 exchange for other property that are outside of the US. So it's US for US, foreign for foreign. The mechanics of the exchange, right? So whatever your sales price is, if it's 1.2 and you have non-recurring closing costs, and that's the issue you want, we can only deduct non-recurring closing costs. And these are going to be costs like title escrow, broker fee, commissions, exchange fee, any transactional fee between buyer and seller. Then you get say you had $100,000 of non-recurring closing costs. So you have a net exchange amount of 1.1 million. So we always recommend that you talk to your CPA to figure that amount out, because we will always say you should be pretty close to your sales price of 1.2, because we don't know what those non-recurring closing costs are going to be. And then any loan that gets paid off, you replace it with a new loan or new cash, or the seller of that property could do seller financing for you too. So you have multiple ways of qualifying the requirements for the debt, or you can assume financing too. So those are the ways that you could offset any loan, is by adding cash, having the seller do seller financing for you. You could assume any existing financing on the property. So these are the ways that you could use your offers when you start making the offers on the replacement property. You could do partial exchange, so you don't have to do a full 1.2 or 1.1 exchange. Basically, you could just go ahead and do $1 million and just pay the taxes on the difference. So down here, as far as what is qualifying, so commissions, title escrow fee, transfer tax, recording fees, exchange fees, inspection, and contractual is going to be basically for the non-recurring. If you give a big credit to the buyer, you have to state it as non-recurring, or you can adjust what? The commissions, right? To give the buyer's agent a little bit more commission and have them use that commission to go ahead and pay for that. We always say, work with your brokers to make sure that that is feasible and between the buyer and seller. So you must check with your brokers regarding that credit and being paid through the commissions. And what is not. So that's why the financing cost. So if we pay any financing, origination points, lender fees, insurance, property taxes, those are recurring costs. So that's why they're not allowed. So that's why if we pay those for the buyer on the 1031 exchange, that's not going to qualify. And when you go buy your replacement property, if we pay any points in origination for the new loan that you're getting, that's also has a high probability of being taxable too, because that's a non-recurring that's a recurring closing cost, and that goes to the lender. So be aware of these closing costs. So always check with your lenders and check with Frank and Debbie to make sure that you guys are understanding these closing cost issues that are coming up a lot frequently now. So a little bit about the timetables. This diagram, basically, the exchange must be opened before the close of escrow of the sale property. So before you close, we have to have everything set up. So we need the contract with the disclosure, right? Escrow with the contact, and then we prepare the title, and then the title report, so we could prepare the exchange documents per the title report, showing the seller, however they hold title, is going to be how we show it up on the exchange documents. That's at the close. That's going to start day 0. You got 45 days to identify your target properties. And then you got to make sure that you close it within 180 days or whenever you have to file your tax returns, whichever comes first. So everybody questions this now because we're at the end of the year. So Frank put a star here because you can go ahead and get your 180 days by filing the automatic extension, right? To file your, include the closing of your 1031 exchange. And then once you close it, then file your tax returns. If you file your tax returns and you're not done with your 1031 exchange, it will basically stop the exchange dead in its tracks because you filed your 2023 tax returns before you completed your 1031 exchange. And that means your exchange is over already. And so that's going to truncate your 1031 exchange. So be aware of that. So always consult with your CPA because you're crossing 2 calendar years. So that's why the 45 days and the 180 days are going to be next year. Because if you sell now, your 45 days is going to be at the end of the year. And your 180 days is going to be somewhere around April, May. And so that's why you need to consult with the CPA if you're going to take that long to find the replacement property to get that extension for that. And then also, the only time that you can get an extension on the 45 days and the 180 days is if you have a natural disaster federally declared, and it's on the IRS looks at it and gives us the extension dates. We had one this year, right? So we had a huge extension for the atmospheric river floods that hit California. Those were extended from way back in January 1st all the way till October, and then it got extended to November. So that's what you have to look for. There are no extensions, so we say don't plan for them. They only come because of a natural disaster, and it's going to be very specific, right, to the area of the natural disaster. Like the fires that we have, they're going to designate what counties will have the extensions. So just be aware of like the news. If you hear anything like that, then double check. Give us a call and find out if there are any extensions regarding that. So some strategies for the 45-day period. Use the CAR form, buyer and seller intent, to exchange supplement, okay? We're seeing it happen right now. So plan with your client. If they got it listed and it's on the market, make sure that you're using that seller intent to exchange, because if they need time to find that replacement property, you need to go in there and check and make a disclosure regarding that and get the buyer to agree to it, that if in fact by the end or close to the end of the escrow period, you need to do an extension, then you have to have that opportunity to go ahead and extend it out to see if there's more properties that are going to be coming onto the market, or if this is contingent upon the seller finding the replacement property. So always check and double check with your client, what are their plans for this property, right? Why are you selling? What are you looking for? Are you talking to your CPA? Are you talking to us? Because you got to protect your client. That's why when you are in negotiations, you have to get this disclosure form out to the buyer to give them notice, right, that your client is doing an 1031 exchange, and here are the conditions. And then vice versa, when you're buying too, and you're making offers for the replacement property, you could use this too to make it contingent upon that property selling. So right now, it's very strategic that you use this CAR form because it gives you the leverage for when you're buying and selling under the 1031 exchange. Because if you need more time, or if you wanted to make it contingent, we're seeing a lot of this exchange supplement come in because people are looking for properties. And once they find it, and if the buyer accepts it, then they want to make sure that they get it. So therefore, it's contingent upon their property selling. So something to be aware of, that use this form because it's out there and it helps you under the 1031 exchange. That's why we're always looking for the contract language, right? It's important to disclose and protect your client. Use this when you receive an offer and also when you submit the intent to 1031 exchange. We have it in our documents, and it's going to be an acknowledgement by the buyer that you are the seller doing a 1031 exchange. And we also have it in our guidebook and our brochures that you need to have some type of contract language stating that it's the buyer or seller doing the 1031 exchange at no cost to the other party. So because we're California, we're escrow state, all parties to the transaction must be aware of what the other party is doing. Because there is an assignment, right? of that property or the escrow closing to us, since we're going to be stepping into the shoes of the seller at the time of sale. We hold the money, and then when they go buy, we're going to step into their shoes when they buy at the close of escrow, because the money is coming from us, showing that it's a completion of the replacement property. And that's why you need to do the disclosure. Identification of replacement properties. So there's 2 rules and 1 exception, right? So the first rule is the 3 property rule. You can have 1, 2, or 3 properties, unlimited in value, disregard to value. So you could go as high as you want. So you can do 10 million, 20 million, 30 million. IRS doesn't care. And so this is the form and how it looks. You'll put the property address, and then you put the fair market value. So you could go 10 million. So if we sold for 1.5, you put 123 ABC Street. You would say also, I'm buying 100%. So you could buy partial of a property. You could buy half, you could buy a quarter, but we need to know very specifically how much you're buying of that property. And then you put your fair market value of what you're going to be buying it for. Or if it's the contract price, then you put the contract price. Oh, here's the other point too. To help your client get a little bit more time of the 45 days, right? Once you're in escrow and you're getting close to closing, let's say everybody, the buyer and the seller are signing to close escrow, you could start making offers for your client to buy the replacement property, because you could say contingent upon this property closing by X date. Then once it closes, you're already in contract, right, to the new property, and then you just have a very short 1031 exchange. So it's always about the closing dates and not so much about the contract dates, because when you put it here, and let's say you're past the 45th day and then property number 1 falls out of escrow, that's why they have 2 and 3 as your backups, right? Then you would have to go see if property number 2 is available or 3 and make an offer on that. And that can be also after the 45 days. And that's why the IRS is the ID statement is your target list, your short list that you need to buy from. So whatever's on that list by the end of the 45th day is what the IRS is looking you to buy. 1, 2, or any combination of all 3 of the properties. The second rule is called the 200% rule. This is where you can identify 4 or more properties, and the total aggregate value cannot exceed twice the value of what you sold. So you would have to come in here and you'll say, list all the properties, give a fair market value to each one, add it all up. Total value cannot exceed twice the value of what I sold, or 200%. So that 200% rule is, if I sold 1.5, I could do 3 million. So my 6 properties here, totaling them all up, cannot exceed $3 million, and that would be a good ID for my 1031 exchange. However, if I exceed the 200%, then I'm going to drop down to this exception. That means that if my total value is now 300%, the IRS says, will let your exchange go through if you buy 95% of the total value of all the properties identified to still have a good exchange. What this means here is you could buy a portfolio, and we're seeing this happen right now. Investors are buying portfolios from other investors. We have portfolios right now that the total value of the properties are over 3, So let's say it's 5, but it goes up to 300%, 3 times the amount of my $1.5 million sale. So it might be 5 million that they're buying for the 1.5. You could do that as long as you buy what? Typically the whole thing. So you got to buy the whole package. And investors are doing that because they're getting better deals. So that's something available. We're seeing, I have, 84 duplexes in Bakersfield, all brand new. They're selling them in chunks of 10. So you could buy a package for like $3 million. So you got 10 at 3 million. So they're looking for an all cash buyer to pick them up. But talk to Frank or Debbie about them. But those are available and that's out there. But you could sell packages. So if you have an investor that has a portfolio, they could sell it to one investor and they could buy it under the 95% rule. So something to think about if you do have big investors. So then example of the 200% rule. So if we sold for 550, it's 1.1. You have to give a fair market value to each property. So if it's Texas, 300. Washington is 400. Vermont is 200. And the other one is 200. So the total value, you add them all up, 1.1. Then that's a good ID. And then you just have to buy any combination of these properties to satisfy the 1031 exchange. So continuity of ownership is something that the IRS and the Franchise Tax Board is looking for. So it's individual, it's the same individual that's buying. You can add, but once you start adding people to the replacement property, you need to talk to your CPA or tax professional, because that means you might decrease the ownership in the property by whatever you're giving the other party. So very critical. And if you're looking for co-signers, that's going to be an issue too. So be careful when you start adding non-exchangers to the replacement property. So as Frank was mentioning, that it's going to trigger a red flag to the IRS and the FTB to make sure that the exchanger is buying enough of the replacement property. So the only time that you could be individual and change it is going to be with the living trust. If it's holding the same taxpayer ID or social security number, then to the IRS, it's the same, right? So if John Smith is selling as an individual, then John Smith could sell as his living trust, his revocable living trust, or John Smith. Or if the single member LLC is him, then that would also be done too if the LLC is a disregarded entity. So we're always looking for continuity of ownership. And this is one of the things that the IRS and Franchise Tax Board is really looking at. So what you're seeing about partnerships is, if we have a partnership, can the owners go their separate ways in a 1031 exchange? The answer to that is questionable. Because there's ways that they do it is they drop the partnership into the individual names while during the escrow period, and they're all tenants in common. And then they try to then go do a 1031 exchange during the escrow, set it up, and go their separate ways. The IRS and Franchise Tax Board do not like that type. They feel that the entity that was holding the property was the partnership. So therefore, their conclusion was that the partnership must be doing the 1031 exchange. So it's always best to get legal advice regarding partnerships that want to bust up, because they should dissolve their partnership months and months ahead of time. Typically, they look for 2 months, not 2 months, but 2 years before selling the property, because the individuals have to show that they've been holding that property as individuals for at least the recommended time of that 2 years. The other way that you could do it is you could exchange with the partnership first and buy multiple properties, and then go ahead and dissolve the partnership, giving each partner whatever the appropriate shares of the ownerships of the properties acquired during the 1031 exchange. So you could either drop first, then swap, which we do not recommend. You could swap and then drop into the individuals. That's more appropriate, and it seems to hold better, I would say, business practices for the 1031 exchange. But this right here, you need to get a CPA, and if you have a real estate attorney involved regarding this, because this is one of the areas that the Franchise Tax Board really is going after, because this is the drop-in swaps do not fly with the California. So be aware when you see that. Related parties. You can buy from a related party or sell to a related party. And what is a related party? A related party is your parents, children's, siblings, spouses, entities with 50% or more ownership. That is considered a related party. So it's lineally grandma, grandpa, grandkids, all the way down to laterally your brothers and sisters are going to be the related party. So if you do sell your property to a related party, there is a 2-year holding period for both parties. You, as the exchanger, must buy the replacement property and hang on to it for a minimum of 2 years. And the related party buying the property from you must hold on to that property for a minimum of 2 years too. And then the other way is basically when you're buying it from a related party, buying the replacement property. You can do that too, but the related party that is selling the replacement property to you must do an exchange as well. And then both exchanges are completed. There is a 2-year holding period for both parties. The reason for this is discouraging basis shifting, where the taxpayer with the low basis trades the property with a related party of a higher basis. This is done to eliminate or reduce capital gains taxes on the sale property that originally had a low basis. So if you're shifting basis, that's what the IRS hates. We don't recommend that you do that, or you have to talk to your CPA or legal counsel regarding these. Okay, because there is that holding period of 2 years for the replacement properties of each. And they're going to kind of look at that and scrutinize. So beware when you're buying from a related party, but it can be done. So Franks, bonus 1031 exchanges. So can you convert the replacement property acquired through a 1031 exchange into my primary residence? It is possible, yes, but it must be used as a rental property first for a minimum of a few years or more before the conversion, because you have to show the IRS the intent to hold as investment first. And everybody says, is it 1? Is it 2? Is it 3 years? We don't know as an exchange company, because there is no guidelines as far as how long it has to be done. That is up to you and your CPA and tax professional to determine that. Okay, so we can't give that tax advice. So If they're looking to move into it and then sell it as a primary residence, it's not 100% tax-free because it's 1031 exchange property. So they're going to look back on it 5 years, and you have to own it for a minimum of 5 years after when you want to make that conversion. So they're going to do the 5-year look back. So you own it at least for a minimum of 5 years, and you have to qualify living there 2 out of the past 5 years. But then the gain is going to be prorated first on a percentage basis. And this is where your CPA has to get involved, because it's not going to be all of the gain is going to be tax-free. It's going to be the years in which it was a rental property, you have to pay the capital gains tax. And then the years that are allocated to the primary residence, that's where you'll get your tax-free prorated amount. So it's not 100% of all the gain that's going to be tax-free. So be aware that was October 22nd, 2002 ruling by the IRS that they changed that tax law. And then combining the strategy for high appreciated primary residence is using the primary residence exclusion with the 1031 exchange. Okay, so you're selling a primary residence has been converted into an investment property for a period of time, preferably about 6 months to 24 months, 16 months to 24 months prior to the sale. You may combine both primary residence exclusion and 1031 exchange treatment of the capital gain. So the property must qualify for living there 2 out of the past 5 years. So that's why as soon as they move out of the property, you remember you have 3 years from the time that they move out to sell the property and still get the exclusion amount, even though it's a rental property. And if it's a rental property, they can do what? A 1031 exchange for the remainder. So that's a big thing that we're seeing a lot of. So here is the strategy for the primary residence, right? Taxpayer bought his primary residence years ago for $300, now selling for $2 million. So you got a $1.7 million capital gains tax. The taxpayer is allowed up to what? $250 or $500,000 of gain under the 121 universal exclusion for primary resident. So if it's a married couple filing joint, you get a $500,000. So now I got 1.2 gain that I got to pay on. But if it's a rental property at the time of sale, right, I get my first $500,000 tax-free. So if I sell for $2 million, $500,000 of the net proceeds comes off the top to me and my wife, and we get that $500,000 tax-free. The difference is what? $1.5 million. Then I could do a 1031 exchange for 1.5. And then so you're able to do both. And then if this property was less, say it was a condo, okay, and then you had this here for 300 and you sell it for 800, right? Then if you come down here and you go into this formula, I wouldn't do the 1031 exchange if I'm selling it for 800, right? So my condo I bought for 300 is selling for 800. I have a $500,000 spread. That's my wife's and I tax-free money. So I wouldn't need to do what? A 1031 exchange, even though it's a rental property at the time of sale. As long as I qualify living there 2 out of the past 5 years, I have $500,000 tax-free. So then my gain here would be what? 0. And then you could sell that property and help out the homeowners. We're seeing this used a lot lately. So this is another marketing strategy that you can ask, right? These are for the people that are downsizing and moving into the 55 plus communities. So something to think about. because we're seeing a lot of people use this strategy. The Delaware Statutory Trust. So these are institutional grade properties, which is a strategy that we're seeing used by many investors, right? So the market, some of the investors are thinking the market is peaking. So this is one of the ways that you could go ahead and help your clients either do a direct 1031 exchange investment into these institutional grade properties. The minimum requirement is 100,000. And they qualify per the IRS for 1031 exchange treatment. So the benefit is asset and geographical diversification because the minimum requirement is 100,000. You could do multifamily, warehousing, self-storage, retail, industrial, oil and gas are all part of the DST structure. They're passive, 100% passive. So you got to remember that. You have no control over the property. And so they're not going to sell the DST if you have to get out. So once you get in, look for staying in that property until they sell. You get monthly cash distributions. You get potential appreciation. They are the tax benefits. If property has improvements on it, then it's going to be depreciation also. There is non-recourse loans against the property and for the investors, okay? There's no recourse to the investors. And as Frank was saying, minimum investment requirements, it's minimum 100,000 per 1031 exchange. The risk are, it's non-liquid, right? You typically have to hold on to it until the sponsor sells. So it's going to be about 5 to 7 year hold. Sponsor does all the tracking, does all the books, and they send you the 1099 or the supplemental income statement that you take to your CPAs to go ahead and file for the DST. But you got to remember, a lot of the DSTs are out in different states other than California. So you got to make sure you file the 3840 with your DSTs because the IRS is looking for those, because when they sell, if you don't reinvest, then you will have to pay the state of California their income tax on that sale. So these are a way to what? Cover boot. So if you don't complete, let's say we sell the $1.5 million example, but you only buy 1.2, you have a $300,000 gap. And if you have $300,000 of cash still sitting in your 1031 exchange, and you don't know what to buy for 300,000, your options are to make sure that you list a DST to cover that 300,000, right? But you got to make sure that you're buying a good DST just because the way the market is right now. So, and you could use the DSTs as backups. So if you're having a hard time in limited inventory, you could identify 1 and 2 in your local Orange County market. And then if you have to, you put number 3 as the DST, but you got to make sure you talk to a financial rep to make sure that that DST is available if in case you don't find or get property 1 and 2, the DST is number 3, that you could roll your client into it and not have them pay any taxes. So, but once they sell, they can opt to do what? A 1031 exchange back into the Orange County market. So this is a way to take some of the money off the table, right? Sideline it. And then once they sell, bring that money back in to the local market. So that's an option. So basically, what's next? How to open an exchange, right? So when you open an exchange, you need to give Frank or Debbie a call, and they could point you in the right direction to one of the administrators and the teams. They will need the following items, right? Property address, the entity who owns the property, persons, LLC, trust, whoever that is, all the contact information of the sellers, their cell phones, emails, mailing address, so they could send the exchange documents, DocuSign, and then put that in the file and also send out statement of funds letters to them. Escrow company contact and information. We coordinate that. We order the title report from escrow to set up the exchange documents and the estimated closing date. So we know that we're preparing and have everything ready upon closing to receive funds on behalf of the client. So we will reach out to the escrow company to obtain the purchase agreement if we don't have that, escrow instructions if we don't have that, and the preliminary title report. Remember, there is an exchange agreement assignment of all parties, right? Instructions to prepare the seller, taxpayer to e-sign prior to the close of escrow. So remember, documents have to be prepared before closing because once escrow closes, done deal. Okay, they will have to pay their taxes. And then same thing on the flip side, when you're buying the replacement property, we need the same thing, right? The cooperation clause seller's doing to cooperate with the exchanger. We have to get escrow contact information. We need a copy of the contract. We know the estimated closing date. And then should we acquire additional funds from the taxpayers, it could be done directly to escrow for closing. And then if they need the EMD to be released for their offer, we could do that too. We just need to know the release form, how much the EMD is for, and then they have to sign the release documents for the EMD to go out to the escrow. So make sure you coordinate that with the administrative team that's handling the exchange, and then they could do all that for you. So the timelines are critical. So the IRS says, when can we allow funds to go out? If there's no identified property within 45 days, then on day 46, the exchange is closed, and then all proceeds are going to be returned back to the taxpayer minus the 3 1/3 or the 12.3 if they give us the amount of gain that they made on the property. If all the properties identified were acquired, and then we're past the 45th day, then basically we can close the account and send back whatever remaining cash is in there and do the California withholding. If you go to the very end of the exchange period, the 181st day, we have to either send that money, we have to send that money to the taxpayer because it's an incomplete 1031 exchange. Therefore, they got to pay the tax. And then we would have to do the California withholding. So make sure that they know that our exchange fees are, for the delayed exchange is 1,250. The reverse exchange is 8,000. The bill to suit is 9,500. Any additional property for the delayed exchange is 350. Any additional property in the reverse exchange and bill to suit is 500. All the fees include round turn, one sale and one purchase. And then how do you work with investors, right? So if you want to do the seminars, always talk to Frank and Debbie to set something up regarding that. Talk to your title reps to get those farm packages for out-of-state owners, in-state owners, local area, anywhere in the California, to go ahead and start marketing for that type of investor that's maybe looking to sell and upgrade their properties to better properties. And basically you can show them, what's their current return on equity of the property. Because if you have debt equity, right, and you have no loan balance and you have a property that's free and clear, you might want to say, hey, you might want to sell that and diversify and get more doors. So that's why on this example here, we got a 4-unit bought in 1995 at 400,000. Fair market value today is 1.8, but there's no debt. So it's all equity. It's like debt equity that's not generating anything, right? So your gross income and your cash flow in this example is going to be about 4%. So now if you go ahead and take that, right, and you try to analyze your return on investment, then you could probably try to get something at about 6%. But here, if you just keep it, and the difference is now I'm going to do a 1031 exchange. The 1031 exchange says you could increase that 6% to almost a 10% annualized return because you're buying up, you're getting more depreciation, and your cash flow has increased. So that's why a 1031 exchange has beneficial value to your investors. And this is one of the reasons why agents work with investors. You just need a handful of investors to do that. So basically, that's the 1031 exchange in a nutshell. There are other strategies. Always give Debbie and Frank a call. They can sit down with you and talk to you about what they're seeing in the marketplace and everything. And now I'll go to the questions. I said, you mentioned partnerships do not qualify for 1031 exchange. Could a tenant in common sell their share to a new buyer in exchange into a new investment? So if it's tenants in common, the tenant in common, so if Debbie and Frank were not a formal partnership, let's say they were 50-50 tenants in common, then if I want to sell my property and do exchange and buy Frank out of his tenant in common ownership, yes, that is a good exchange. However, if Debbie and Frank had a partnership, an LLC, and I wanted to sell my 1031 exchange property and then buy Frank's interest in the LLC out, no, that would not work. So that's why it's very important that you see how title is held, because if Debbie and Frank had that as a formal partnership, then they as the partnership would have to do the 1031 exchange, right? If they sell their property that they hold, they would have to do an exchange as a partnership. So partnerships can do an exchange, as just the individual partners cannot, because you're buying an interest in a partnership and you're not buying the property. So that's a good question. And then let's see. In the chat, let's see, here we go. I'm reading over the chats. It says, you mentioned you can't do an exchange for primary residence. So, because primary residence is, if it's owner occupied at the time of sale, you cannot do a 1031 exchange, because 1031 exchanges are for properties held for investment, right? So primary residence is section 121. So if it's not a rental, it hasn't been converted to a rental property, and this is where the CPA has to make that distinction, then you cannot, because it's being sold as a primary residence. Let's say in the example was, if I only lived there for 18 months as primary residence and I got to sell it because I'm moving, you have to work with your CPA to see if you qualify for one of the hardships, right? Loss of job, job transfer, death, disability, divorce, something of that nature that's going to qualify you for an exclusion on that. But typically, no, primary residents do not qualify for 1031 exchange treatment. So if you guys need, the recording will be available. Just call into the association and they will get you that. Also, if you need a copy of the presentation, you can get that too. Just ask the association, and that would be all taken care of. Any other questions? If not, feel free to reach out to Debbie and Frank. But I thank you very much.